cash and cash-like investments. Meet Sarah. She keeps all her money in cash because it feels safe. But there's a problem. While Sarah sleeps, inflation is quietly eating her money like a hungry monster. Every year, her $10,000 buys less groceries, less gas, less everything. Cash investments aren't just stuffing bills under your mattress. There's savings accounts that pay almost nothing, high-yield savings accounts that actually fight inflation, money market accounts that let you write checks, and certificates of deposit that lock your money away like a time capsule. Cash is the foundation of every investment strategy. It's liquid, meaning you can access it instantly. But liquidity comes with a cost. The safer and more accessible your money, the less it grows. Cash is your emergency fund, not your wealth-building tool. Stocks. When you buy a stock, you're buying a tiny slice of a real company. Buy Apple stock, you own a microscopic piece of every iPhone sold. Buy Tesla stock, you own a fraction of every car they manufacture. There are two main flavors of stocks. Growth stocks are like planting a seed. You're betting the company will grow bigger and your slice becomes more valuable. Think Amazon in 1997. Dividend stocks are like owning a money tree. Mature companies like Coca-Cola pay you cash every quarter just for owning their stock. But stocks are volatile. They go up, they go down, sometimes they crash spectacularly. The stock market has crashed dozens of times in the last century. But here's the secret. Over long periods, stocks have outperformed almost every other investment. The S&P 500 has averaged about 10% annual returns for the past 90 years. This is why time is your best friend with stocks. $10,000 invested in the stock market for 30 years becomes $174,000. That's the power of compound growth. But you need patience and the stomach to ride out the crashes. Bonds and fixed income. Bonds are basically I owe us. You lend money to the government or a corporation, and they promise to pay you back with interest. It's like being the bank instead of the borrower. There are different types of bonds. Government bonds are super safe, but pay less. Corporate bonds pay more, but carry risk that the company might go bankrupt. Municipal bonds help fund cities and are often tax-free. Junk bonds pay high interest because they're risky as hell. Here's the tricky part about bonds. When interest rates rise, existing bond prices fall. It's like buying a car right before the new model comes out. Your old car is worth less because everyone wants the newer, better version. Bonds are the boring, stable part of your portfolio. When stocks crash, bonds usually hold steady or even go up. That's why many investors use a 60-40 split, 60% stocks for growth, 40% bonds for stability. Funds. Imagine trying to cook a gourmet meal by buying every ingredient separately versus buying a meal kit with everything included. That's the difference between buying individual stocks and buying funds. Mutual funds have a manager who actively picks stocks, trying to beat the market. They charge higher fees because someone's getting paid to make those decisions. Index funds just buy everything in an index, like the S&P 500. No thinking required, lower fees. Exchange-traded funds, or ETFs, are like index funds that trade like stocks. You can buy and sell them anytime the market's open. Mutual funds only price once per day after markets close. Here's why fees matter. A 1.5% expense ratio versus a 0.03% expense ratio might not sound like much. But over 30 years, that difference costs you tens of thousands of dollars. Most actively managed funds don't even beat the market after fees. Real estate. Real estate is the investment you can live in. Buy a house, rent it out, collect monthly income while the property hopefully appreciates in value. It's like having a money printing machine in your backyard. You don't have to buy physical property. REITs, or real estate investment trusts, let you own pieces of commercial real estate through the stock market. Real estate crowdfunding platforms let you invest in properties with just a few $100s. But real estate isn't passive income, it's a business. Toilets break at 2 a.m. Tenants stop paying rent. Property taxes go up. Maintenance costs money. You're not just an investor, you're a landlord. Real estate historically keeps pace with inflation. Plus, you can use leverage, meaning you can buy a $500,000 property with just $100,000 down. If the property goes up 10%, you made 50% on your invested capital. But leverage works both ways. If property values fall, you can lose more than you invested. Alternative investments. Alternative investments are where wealthy people park money when traditional investments feel too mainstream. We're talking private equity, hedge funds, venture capital, art, wine, collectibles. Private equity firms buy entire companies, fix them up, and sell them for profit. Hedge funds use complex strategies like short selling, derivatives, and leverage to make money in any market condition. These typically require millions to get in. Then there's collectibles. Art, wine, classic cars, rare books, vintage guitars. These can appreciate dramatically, but they're illiquid and require expertise. You need to know the difference between a Picasso and a fake. Alternative investments often move independently of stocks and bonds, providing diversification. But they're usually illiquid, meaning you can't easily sell them. They also require higher minimums and charge higher fees. Business ownership. The wealthiest people don't just invest in businesses, they own businesses. Starting a company is like planting a money tree that could grow into a money forest. You can start a service business with just your skills, create a product business that scales, build a digital business that runs while you sleep, or buy a franchise with a proven system. But business ownership isn't investing, it's working. You're not buying a stock and forgetting about it. You're building something from scratch, dealing with employees, customers, regulations, and taxes. Business ownership offers unlimited upside potential. There's no cap on how much you can make, but it also requires the most time, energy, and risk. Most businesses fail within 5 years. Commodities and hard assets. For thousands of years, humans have valued gold, silver, and other physical commodities. When paper money becomes worthless, gold still buys bread. Commodities include precious metals like gold and silver, energy like oil and natural gas, agricultural products like wheat and corn, and industrial metals like copper and aluminum. Commodities are inflation hedges. When the cost of everything goes up, commodity prices usually go up too. They maintain purchasing power when currencies lose value. But commodities are volatile and produce no income. Gold doesn't pay dividends. Oil barrels don't send you checks. You're betting purely on price appreciation, and prices can swing wildly based on supply and demand. Crypto and digital assets. Cryptocurrency is money without banks. Instead of trusting a government or institution, you trust mathematics and computer networks. Bitcoin is digital gold, designed to be scarce and store value. Ethereum is programmable money that enables smart contracts and decentralized applications. Then there are thousands of altcoins, each promising to revolutionize something. Crypto is the most volatile investment on this list. Bitcoin has crashed 80% multiple times, but has also produced returns that make traditional investments look boring. Early Bitcoin investors became millionaires, but many others lost everything. Crypto is still experimental. Governments are figuring out how to regulate it. Technology is evolving rapidly. It could be the future of money, or it could be a speculative bubble. Nobody knows for sure. Retirement-specific investments. Retirement accounts aren't investments themselves. They're tax-advantaged containers for investments. Put money in a 401k or IRA, get a tax break now, let it grow tax-free until retirement. Traditional IRAs and 401ks give you tax deductions now, but you pay taxes when you withdraw in retirement. Roth IRAs work backwards. You pay taxes now, but withdrawals in retirement are tax-free. Many employers match 401k contributions. If your company matches 50% of your contributions up to 6% of your salary, that's an instant 50% return on your money. It's free money. The tax advantages make retirement accounts incredibly powerful for long-term wealth building. Tax-deferred growth over 30 to 40 years creates compound interest on steroids. Speculative and niche investments. Some investments are basically legalized gambling. Penny stocks, options trading, futures contracts, forex trading, high potential returns, high probability of losing everything. Day trading looks glamorous on social media. Buy a stock at 9 a.m., sell it at 11 a.m., make quick profits. But studies show 90% of day traders lose money. It's not investing, it's speculation. Options give you the right to buy or sell stocks at specific prices. They're leveraged, meaning small moves in the underlying stock create big moves in the option price. You can make 1,000% returns or lose 100% of your investment. There's a difference between investing and gambling. Investing is buying assets that produce value over time. Speculation is betting on short-term price movements. Both have their place, but don't confuse them. Non-traditional investments. The best investment might not be financial at all. Investing in yourself through education, skills, networking, and personal development often produces the highest returns. A college degree, professional certification, or new skill can increase your earning potential for decades. Learning to code, getting an MBA, or mastering sales can be worth millions over a career. Social capital matters too. The relationships you build, the reputation you create, the network you develop. These intangible assets often determine your success more than your investment portfolio. Your ability to earn money is the foundation for all other investments. You can't invest what you don't have. Increasing your income through skills and relationships often beats trying to optimize investment returns. Every investment fits somewhere on the risk-return spectrum. Cash and bonds at the bottom for safety. Stocks and real estate in the middle for growth. Alternative investments and speculation at the top for maximum risk and potential reward. Your investment mix should match your age, goals, and risk tolerance. Young people can afford more risk because they have time to recover from losses. Older people need more stability because they're closer to needing the money. Diversification is your best friend. Don't put all your eggs in one basket. Spread your money across different investment types. Different industries, different countries. When one investment crashes, others might soar. The most important investment principle isn't which investments to choose, it's starting early, investing consistently and avoiding emotional decisions. Time in the market beats timing the market, because the best investment strategy is the one you can stick with for decades. And the best time to start investing was yesterday. The second best time is today.